Hello everyone, my name is Pawan and in this video I want to talk about the infamous Adani Group stocks. And considering that the stock price have crashed now after the Hindenburg research report, does it make sense to invest in them? The Hindenburg research report has put a lot of serious allegations in the group, starting from stock manipulation to the political affiliations that the company has, which helped them to take the kind of debt that they've raised over the last few years. It has put a lot of dent in the trust factor for the Indian market, which kind of resulted in the underperformance that we have seen in the last 1 to 2 months if you compare it with the rest of the world, say US market and etc. Stock market is one of the few places where we have a fear of missing out, which meaning if there's a lot of frenziness, or if there's something that stock that's going up crazily, everyone wants to participate in it and make a quick buck, which is what happened in the Adani Group stocks. If you look at it in the last years, a lot of stocks has gone up by 500,000, 2,000, some 3,000%. There are few lucky ones who caught the momentum and made some decent returns, but there are a lot who burned their fingers trying to chase the momentum or even trying to buy the dip that we have seen in the last few weeks after the research report that is published. So what I don't want to talk about in this video is the kind of allegations that the research report has made and Adani's response to it, because I'm sure you must have seen a lot of videos on it and I don't want to bore you with that again. As an investor, what's important for us is that when we are putting our hard-earned money to work or investing in a particular company, it's important for us to look at the businesses at the core of it and try to understand what are the growth opportunities that the businesses has and what are the risk factors that the businesses has, and be impartial about it, because it's very easy to get carried away in this entire saga that okay, Hindenburg is true or Adani is true, because everybody has their own agendas maybe at the end of the day. So let's not get into in taking sides. Let's be impartial about it and look businesses at the core of it. Look at Adani businesses, Adani Group stocks and businesses that they are into at the core of it, and understand with some of the fundamental ratios and fundamental analysis, and see whether it makes sense to put our money to work and invest in Adani Group stocks. So what is the business that Adani Group are into? Adani Group, the total of broadly 6 companies that the Adani Group is into. If you don't consider the recent controlling stakes that they have made in, say, NDTV or ACC and Ambuja Cements and etc. If you look at the 6 stocks that the Adani Group has, say starting from Adani Enterprises, which is mostly into the coal mining and manufacturing and defense and aerospace sectors and agri storage infrastructure and etc. It is basically a diverse company. If you look at the history, Adani Enterprises was like one big conglomerate, like how Reliance Industries is now, and later on it slowly started diversifying or started listing different subsidiaries into different entities, different listed entities, which is what happened after that. Like Adani Green Energy has come up, which is mainly into renewable energy company focused on solar power, and Adani Ports and Special Economic Zone. This is a private port operator and that takes care of the cargo handling and logistics kind of business. Adani Power and Adani Transmission, which is mainly into power generation and distribution and power transmission company. And Adani Wilmar again is a joint venture between Adani Group and Wilmar International. They're mainly into edible oils. I mean, if you look at Fortune as a cooking oil, that is a part of Adani Group. Broadly, the company's product portfolio include the edible oils and including soya bean, sunflower, mustard, rice bran oil, and vanaspati and pulses and etc. So that is what the businesses that the company has. So the broad point is that company is mainly into very highly capital intensive businesses, and they need a lot of capital to set up a lot of manufacturing plants, whether it is on the power and distribution businesses that they have on the port side. And Adani Enterprises, they're also involved in some kind of infrastructure projects starting from airports and etc. So which means that they need to take a lot of debt as well to run these businesses. Taking debt is not a problem, but how much debt you are taking and where are you utilizing that money to generate what kind of cash flows that you're generating is very important. If you look at Tata Steel, if you look at Reliance Industries, there are many other highly capital intensive businesses that are leveraged a lot, that they have a lot of debt in their balance sheet, and debt is actually very important for those kind of businesses to run. But it's also very important to understand how are you deploying this capital to generate more cash flows, to generate more ROCs. So how does Adani Group stocks fare in all these metrics? So let's look at some of the data and financial ratios of all the Adani Group stocks and understand what are the growth opportunities that are possessed over there, and what are the risks that you need to be aware of. So I consolidated all the numbers for Adani Group stock and all the important metrics for Adani Group stocks, for all 6 stocks mainly, in one Excel sheet so that we can see the complete picture. So if you look at the sales growth and margin growth, EBIT growth and the net profit growth in the particular company, then for example in the sales growth in the last 3 years, the Adani enterprise has about 20%, margin is about 21%, net profit not so great because the sales has gone up by nearly 20% and the net profit is just 9%. And if you look at Adani Green, also very decent, 35, 57 and 42% in terms of net profit growth is concerned. And same with Adani Ports, which is decent. And if you look at Adani Power and Adani Transmission, also looks decent. And the ROCEs and ROEs, return on capital employed and return on equity, is also decent. There's nothing bad in terms of the numbers that shows that the business is in danger. But the most important thing that we need to consider here is how are they generating whatever the profits or whatever the margins, whatever the sales growth that they're generating. They are generating through by taking a lot of debt, which you can see it in the B, C, D column. If you look at the total debt they have taken, each company has taken, and the kind of rise in debt that they have in the last 3 years. The B column talks about the total debt, and the C column talks about the current debt, and the D column talks about the percentage rise in debt in the last 3 years. So Adani Enterprises and Adani Green has the debt in those two companies has increased by over close to 300% in the last 3 years. And same with Adani Transmission and Adani Ports, not as much crazy as the other two Adani stocks, Adani Enterprise and Adani Green, but still very significant, almost 60% increase in debt in the last 3 years. And if you look at some of the important two financial metrics that generally many investors track when it comes to companies that have taken a lot of debt, is debt to equity ratio and interest coverage ratio. Before getting into these details, let's understand what it is debt to equity ratio is all about. The debt to equity ratio is a simple financial ratio that compares a company's total debt to its total equity. It is a measure to understand the kind of leverage that the company has. The formula for calculating debt to equity ratio is actually very simple. It is total debt divided by total equity. The higher debt to equity ratio indicates that the company may have the financial risk because most of their assets are financed by debt. And the lower debt to equity ratio is actually the opposite. Ideally, even when the companies are taking a lot of debt, ideally you should have a low debt to equity ratio which should be less than 1. It's a very commonly used ratio in financial analysis and credit analysis. The ideal debt to equity ratio may vary by industry, but ideally I believe even for the companies that are highly capital intensive should have a debt to equity ratio that is less than 1. That the lower the debt to equity ratio, the preferred it should be for the investors, because that indicates a lower level of financial risk. The other ratio, the interest coverage ratio, is a simple financial ratio that measures a company's ability to pay interest on its outstanding debt. So it's simply calculated by its EBIT, earnings before interest and taxes, divided by the interest expenses. The higher interest rate coverage ratio means that the company has more earnings at least to pay its interest. It is more capable. It is considered to be more capable of servicing its debt. On the other hand, the lower interest rate coverage ratio means that the company has difficult paying its interest expenses and may be at a higher risk of defaulting that debt. So it is very simple. If the interest coverage ratio should be high, ideally should be more than 4, but even if it is more than 6, that will be ideal. And the debt to equity ratio has to be lesser. And if you look at the debt to equity ratio and interest coverage ratio in this column for Adani stocks, and most of the debt to equity ratio is more than 1, and the higher debt to equity ratio in the entire group is Adani Green, which is a big red flag. It's almost 7.7. And the lowest could be Adani Wilmar, and even Adani Ports is also okay. Everything is close to red flag in terms of taking an investment decision on this is concerned. And the interest coverage ratio is something which is very important, because the only Adani Power has highest interest coverage ratio, which is a comfortable level about 4. The rest is almost hovering around 1.5 to 3 at best, at best maximum. That is a very big red flag, because consider this scenario. This is actually one of the biggest risk factor for the group. And these are very cyclical businesses, right? What if the recession and everything is looming around? What if the next 1-2 years the businesses don't do that well as much as they expected to do? Then they go into kind of vicious circle where they have to take even more debt to finance their operations, which means even to pay interest for the debt that they have taken, it could be very difficult. And combine that with the kind of stock price increase that the stocks have seen in the last 3 years. This is before the crash, which is close to almost 2,000, 3,300, 1,300%. I don't know for what joy the stock prices have gone up so much. It just doesn't make sense considering the kind of financial ratios that the company is having. The J column talks about the price increase after the crash, after the 50% or more than 50% crash that you've seen in most of the stocks. So this data may be about a week's old. So consider maybe the stocks have gone up now, and this percentage may be a bit more. Even after 50% crash, most of the stocks are still up by almost 200%, or 100%, or 1600% in the case of Adani Enterprises. There is still a lot of frenziness that is still there, and in terms of PE ratio, it's still extremely high for a high capital intensive businesses. And if you look at a lot of capital intensive business, take an example of Tata Steel or many other power distribution companies that you can see, where the PE is does not even exceed 10 in most of the cases, because that's what the industry that's what the general norm in terms of the PE that the investors give for the capital intensive businesses. So my honest takeaway is that if you simply put all these stocks, considering the kind of debt that the group has, into simple risk reward framework, which I've kind of talked about in my last video. If you haven't watched it, I'll put the link in the description below. Please have a look at it. If you simply consider all the risk factors that I've just mentioned on the debt servicing is concerned for the Adani Group stocks, and how risky it is that they could default on their debt if the business cycle goes bad. Now, with all the Hindenburg research that has come out, and the kind of debt that the company already has, and if they want to take or get more financing or more debt, it becomes very difficult for the company to raise any kind of capital or any kind of debt now in the current market scenario, in the current kind of trust deficit factor that the company is facing. So considering all this, if I simply put this in risk reward framework that I've talked about in my previous video, for me this comes under high risk and low reward kind of environment, and that is a completely danger zone for me, and I don't even want to think about putting any kind of money to work. There are other stocks in the Adani Group like Ambuja Cements, where they acquired the majority of the stake, and they're better managed in terms of cash flows, and they have a very big moat in terms of entry barriers also. So which one could consider investing, but for me personally, I don't want to jump the gun and put my money to work when there's a lot of allegations, a lot of risks that is there, because you don't know what kind of related party transactions that could come up in the future also. But I wouldn't want to touch it, because why should I take a risk that gives me sleepless nights, rather than I invest in businesses that I can understand. And I believe market is not about picking the right one, because we don't know which one will turn out to be multi-baggers or consistent compounders, or it's about having some kind of investment criteria that can filter out the bad ones, filter out the bad apples, and just completely avoid them. And for me, Adani Group stocks can be fall under the criteria which I can completely avoid and just have a peaceful sleep night. I hope this is useful. Please let me know any feedback in the comment section below. And if you haven't subscribed to my channel yet, please do. This is Pawan. I'll see you in my next video.